Imagine a world where every crisis, every war, every recession, every collapse, every panic did not simply happen, but was quietly turned into an opportunity by those wealthy enough, powerful enough, or informed enough to see disaster not as danger but as profit. A world where the rich did not just survive turbulent times, they bought them, shaped them, and in many cases engineered the systems that allowed them to become richer from the ashes of global chaos. Welcome to Retro Finance Files, and today we dive into one of the most controversial and fascinating truths in economic history: how the rich bought every crisis in history. Before we begin, make sure to like, subscribe, and share. Your support helps us uncover the hidden financial stories that shaped our world. And now, let's begin our journey. To understand how the wealthy turned crises into fortunes, we must go back to the earliest financial collapses. In 1340s Europe, the Black Death wiped out nearly half of the continent's population. While ordinary farmers and peasants died in poverty, the wealthy merchant families of Florence, like the Medici, used the chaos to consolidate power. With labor shortages driving wages up, many nobles were forced to sell land at extremely low prices to stay afloat. The Medici bought these lands, expanded their influence, and ultimately created one of the world's first true banking dynasties. Crises have always redistributed wealth, but usually upward. Take the infamous South Sea Bubble of 1720. When it burst, tens of thousands lost their savings, but politically connected investors dumped their shares early thanks to insider information. Many historians note that members of British Parliament escaped ruin, while everyday citizens were financially destroyed. Moving forward to the American Civil War, the Rothschild banking family funded major governments on both sides of European conflicts for over a century. While they did not fund both sides of the U.S. Civil War, as some myths claim, it is true that financiers in Europe bought U.S. bonds at deep discounts during wartime panic, reaping enormous profits when the Union won and bond values soared again. The lesson repeated through history: during instability, those with capital dictate the rules. As we enter the 20th century, the clearest example of crisis-based profit appears during the Great Depression. While millions of Americans stood in breadlines, wealthy industrialists and investment groups used the market crash of 1929 to buy valuable assets for pennies. The Rockefeller family alone increased its fortune dramatically by acquiring entire companies that had collapsed under debt. One famous quote attributed to John D. Rockefeller Sr. was, "Depression is good for the rich," reflecting the harsh truth that wealth concentration increases during downturns. This is supported by economic studies. Between 1929 and 1935, the wealthiest 1% of Americans increased their share of national wealth despite the economic collapse. World War II further reshaped wealth. While tens of millions died, corporations supplying weapons, food, and fuel experienced unprecedented profits. Companies like Boeing, Ford, and General Motors became global giants through government contracts. Meanwhile, the famous Nye Committee report revealed that American arms manufacturers had earned so much money during World War I that they were labeled merchants of death. Crisis profiteering became so obvious that the U.S. Senate launched multiple investigations. Then came 1971, when the biggest economic crisis almost nobody understood in real time. When President Nixon ended the gold standard, global currencies floated freely for the first time. Market uncertainty skyrocketed. But wealthy traders, especially those with insider access to political decisions, made fortunes betting on currency movements. Billionaires such as George Soros later repeated this strategy, famously shorting the British pound in 1992 and earning $1 billion in a single day. Meanwhile, recessions in the 1970s caused layoffs, inflation, and economic anxiety for millions. But corporations used those crises to automate production, lower labor costs, and expand globally. Let's jump to the 2008 financial crisis, an event still fresh in global memory. Millions of families lost homes in the foreclosure wave, but private equity firms like Blackstone and Cerberus bought tens of thousands of houses at distressed prices, turning them into massive rental empires. In fact, Blackstone became the largest landlord in the United States after the crisis, owning more than 80,000 homes. At the same time, banks deemed too big to fail received bailouts worth hundreds of billions through the U.S. Treasury and the Federal Reserve. According to government records, the total direct and indirect support to stabilize financial institutions exceeded $700 billion, and yet very little of that money went to homeowners or small businesses. Once again, crisis money flowed upward. The COVID-19 pandemic was another massive example. In 2020, while the world locked down, billionaire wealth increased by an estimated $4 trillion in less than a year, according to Oxfam. Tech giants like Amazon, Apple, Microsoft, and Google saw record profits as digital services replaced physical ones. Meanwhile, small businesses collapsed at the fastest rate in modern U.S. history. As governments injected trillions into markets through stimulus and quantitative easing, much of that liquidity went straight into stocks, real estate, and crypto assets mostly owned by the wealthy. A study by the U.S. Federal Reserve concluded that 80% of stimulus-driven asset growth benefited the top 10% of Americans. But this pattern is not new. It is the continuation of a centuries-long cycle. Crisis gives collapse for the poor, gives consolidation for the rich. Let's examine how the wealthy systematically turn crisis into profit. One method is liquidity advantage. The wealthy hold cash or assets they can liquidate quickly. When markets crash, they buy undervalued assets. Normal people panic sell while the wealthy accumulate. Another method is information advantage. Historically, elites received early warnings, whether from political insiders, corporate networks, or privileged data. This allows them to escape losses and position themselves for gains. Third, the rich influence policy. In nearly every major crisis, governments pass emergency laws that protect corporations, banks, and investors. During the 2008 crash, banks received massive bailouts. During COVID, corporations benefited from subsidies and tax credits. Ordinary people received small stimulus checks. The rich received asset protection. Fourth, the wealthy used private equity and vulture funds to buy distressed companies cheaply. This practice emerged in the 1980s and exploded after the 2008 crash. Private equity now controls over $10 trillion in global assets. Many of these acquisitions occur during crises when companies cannot survive without being bought. Fifth, crises reset markets, and resets favor those with capital. When markets collapse, expensive assets like land, oil reserves, or infrastructure become affordable only to the wealthy. Sixth, crises shift consumer behavior. During the pandemic, consumer habits moved digital, boosting tech giants. During oil crises, energy companies raise prices. During wars, defense contractors win long-term contracts. Seventh, inflation itself benefits the wealthy. When inflation rises, wages almost never rise at the same pace, but investments often do. According to the Bank of International Settlements, over 60% of global billionaire wealth is tied to asset classes that rise during inflation. Ordinary people, meanwhile, suffer because daily goods become more expensive. Eighth, crises allow wealth transfer. When millions lose jobs or homes, they often sell possessions or property at a loss. Wealthy investors buy. Ninth, crises normalize unfair policies. Surveillance, corporate consolidation, emergency powers, reduced competition. And finally, wealth buys influence. In almost every crisis in history, those with the resources to lobby, negotiate, buy, or manipulate markets gain the advantage. Whether in the Roman Empire, medieval Europe, industrial Britain, Cold War America, or modern China, elites used crises to strengthen their position. But it doesn't stop there. Even natural disasters create profit. After Hurricane Katrina, large developers bought ruined neighborhoods in New Orleans for low prices. After Japan's 2011 tsunami, private investors acquired devastated fisheries and factories. After every major wildfire in California, land speculation spikes. Crisis capitalism is not a conspiracy. It is a structural feature of the global economy. The people with capital buy the opportunities created when everything else falls apart. As the saying goes, when there's blood on the streets, even if it's your own you buy. And what about the future? Will the pattern continue? Absolutely. Today we face new crises. AI replacing jobs inflation, rising in dozens of countries water scarcity in the Middle East and Africa, real estate bubbles across. Asia and North America climate disasters, increasing globally debt levels at record highs and geopolitical tensions between the US, China, Russia, and Europe. Each of these crises is already being turned into profit. AI companies are valued in the trillions. Water rights are being bought by hedge funds. Real estate speculators are buying land where climate refugees will relocate. Defense companies are seeing historic profits due to global tension. The lesson is timeless. Crises reshape the world, and the wealthy write the new rules. If you found this deep dive into financial history eye-opening, make sure to like, share, and subscribe for more videos on how money, power, and history collide. Thank you for watching Retro Finance Files, and I'll see you in the next episode.